Hi everybody, this is Gary Dean and this is our nightly video report for Thursday, April 12th, 2016. Quick note, I am going to be out tomorrow all day, so there's not going to be any morning notes. I'm leaving at like 7 o'clock and I won't be back until Sunday, so nothing is going to be going on tomorrow as far as the morning notes. So let's get started. Today was a pretty wild ride. They gapped it up only to crash it down, only to rally it back again. They're just keeping everybody on edge right now. And this is typically what happens towards the end of a move. Now, being that this is our say, breadth charts, these things are still as overextended as I've ever seen them. And, you know, we're not even, the S&P is not even close to the first high. So this is saying that the longer term trend, like the longer term move or the bigger move point wise, is going to be to the downside. So if we take a look at the VIX here, you can see these are not levels that you want to be going aggressively long. You actually want to be looking to short because we have the VIX at support and you have the S&P that ran into resistance. So my guess is they're going to meet back in the middle again at some point, and that means that we're probably going to see the equity markets head lower at some point. You can see the put call ratio. We got pretty high in the puts here. So there's a shot that we could, see a little bit more of a rally attempt tomorrow, maybe pull this back down. But in any case, the bigger trend is still on the downside. And really, that's about it. So one other thing I want to show you is even though we had, pretty good reversal in the SPY, the big boys were selling it, so that's not a good thing for the long side. I would definitely keep a neutral bias. If anything, start looking to cash out of your long position, especially if we get a rally tomorrow or on Monday, and just wait for the signal to go short. So another reason why the longer term move that I'm looking at is lower is because of the wave count as well as the pattern here, and this is suggesting that we're going to get a move someplace between 1960 and 1874. So we're not even close to that. So there's still a lot more room to go to get into these levels. Plus, we're coming off of bearish divergences. On the 60-minute chart, you can see the bullish divergences here at the lows caused a big rally. We made it right up to the 62% retracement and then a hard drop. And if you notice, this is, they're buying the moving average here. So it's a dangerous game because this is heading down and this is heading up. So a lot of people buy these moving averages and it ends up being a trap because they're all locked in here. And the next thing when we break through it, it turns into panic selling. So anyway, you can see the moving averages here are acting as support and resistance. So if they pop above, say this 2074, then we're probably making a move up to the 2083. If they can get through that, then we're going up to the 2095. Now this was kind of the line in the sand for the bulls, but once we broke through that, and we hit the moving average that I just showed you, we found buyers stepping in. So if they would have closed below that, that's when things probably would have been really in panic mode. But right now, you can see that we don't have any bearish divergences, so that's suggesting that we actually still could make a move back up or past these levels. The fact that they gave back almost all of this in a very, very fast manner is telling me that trading the upside is dangerous, even though you want to leave the door open for it. And I think really what you'd want to do is, if it gets up to these levels, just look to, start building a short position up in this, because I think the bigger move is to the downside. So we're neutral on the 60-minute chart. We don't have any bearish divergences. We don't have any bullish divergences besides the low here, but this already played out. And finally, on the 15-minute chart, you can see that the S&P went all the way back close to the 78% retracement. So it shouldn't have gone up like this and then straight down, even though it may be just a head fake. My take is it's an A, B, and if we head up, it's going to be a C. But there's a chance that this is just an A, B, C already, and now we're heading down, and this is just a back test before we head lower. So my thing is keep a neutral view right now. I think buying this market right now is very dangerous, but I think you just want to let the short side play out, make sure that we are seeing the trend or the momentum moving down. because we know that some of these rallies or counter trend rallies can be face ripping, and you don't want to fall into the complacent end of things with people. You want to be looking to pick and choose where you want to short, but again, you want to be a little bit patient. And with that, enjoy your weekend, and I will talk to you guys on Monday.